Today, we're going to be speaking to a stock market advisor about what's hot in the market and a few global trends that will affect the ASX in 2024 and beyond. Any advice that is given here is general in nature, and you should seek your own advice before acting on anything that you hear today. Hi everyone, and welcome to our next episode of the Solve to Evolve podcast. Today we have Mitch Stone with us. Mitch is the founder and director of InvestWithMitch, a share market advice business that helps Australian investors navigate the market and grow profitable share portfolios. Mitch has a background in stockbroking from his time at JP Morgan and has over 18 years experience in share market investing and general market exposure. Welcome, Mitch.
Thanks, mate. Cheers.
So, Mitch, tell us a bit more about your business, why you started it, and what you do day to day.
Yeah, good question. So, look, by trade, I'm a stockbroker. However, I've pivoted away from telephone stockbroking into the online space. You know, about 95% of investors buy and sell their shares online these days. So, I couldn't really see a long future in stockbroking. And so now I've created a business where I service those online investors. So, look, to put it simply, I tell mum and dad investors which shares I believe are going to rise in value.
That's very interesting. And does that involve a certain degree of like portfolio planning and helping them actually pick what stocks to buy or sell at any point in time?
So look, the level of advice that I provide is general, right? So I don't specifically say, hey, Blox, you should invest 50 grand into BHP and 20 grand into the banks. It is a general portfolio. And I guess from what I understand, investors, you can really put them into sort of two categories. You've got your older, retired type investors who are looking for dividends, right? Passive income. And then you've got your sort of younger investors who are still working, looking for growth. And a typical client of mine would still be working, looking to grow their portfolio, grow their wealth before they retire. And when they do, well, then they'll probably switch into sort of boring, safe dividend stocks, if that makes sense.
Sure. And so you can help anyone along kind of any stage of the spectrum, the age spectrum, or the risk preference spectrum. Is that right?
Well, look, I can help anybody get started in the share market, but whether my service is right for them is I guess, dependent on their risk profile. You know, I typically recommend riskier stocks that have the potential to grow, and that's not everybody's cup of tea, if that makes sense. So, yeah, a typical client of mine would be around 40 to 50 years old with maybe $100,000 to invest into the market.
Sure. And so you can help people from starting investing all the way through to kind of maybe a bit more down the age spectrum to retirement.
Yeah, absolutely. So the way that my sales funnel works is I have a free training that teaches people how to buy and sell shares online. Then I talk about some of the current opportunities in the market. And if they like what they hear and they want to continue, well, then I put together a membership package for them to consider.
Excellent. So moving on to the market now. So
yes.
How do you see things evolving in 2024? What do you feel are some important trends? What do you think is going to happen?
So look, I've thought the market was going to crash for so long, but it just hasn't sort of come. So the ASX at 7,400 points, it's probably where it should be. Look, I can't see the market crashing this year unless the Reserve Bank do something crazy like lift interest rates. But the way inflation's cooling, I think they'll probably cut 2 or 3 times this year, and that should support the markets. So, I think the markets will probably rise anywhere between 5 and 10% in 2024.
You mentioned interest rates.
Yes.
Can you just expand a bit on, for the benefit of our viewers who may not be as financially kind of aware as yourself, generally interest rates get a lot of coverage in the media.
Yes.
Can you tell us how does interest rates affect
the market,
other asset classes, and the market in particular?
Yeah, that's a really good question, right? So the Reserve Bank they've got a target range of inflation, right, which is basically the cost of goods and services. That target range is between 2 and 3%. So if things are rising too quickly, if inflation's at 5% where it is now or rising, they lift interest rates. And what that does is it makes the cost of debt more expensive. Things like your big ticket items like mortgages, right? But also personal loans and credit card debt as well. So it affects all sorts of debt. Now, when the cost of debt rises, Well, that means less disposable income for households and less money in the economy, and basically lowers retail sales and consumer confidence. So it's really a lever that the RBA pulls. So how does it affect the markets? Well, if interest rates are high, that means a higher percentage of people's income are going towards paying off debt, whether it be their mortgages because they're more expensive or credit card. And people just aren't out in the economy spending as much. But the inverse is true as well. When the economy's not doing so well, the RBA need to sort of stimulate things so they lower interest rates. And that means that there's more money in the economy and the cost of debt is cheaper and companies can grow.
Okay. And there's a lot of things happening around the world at the moment that can affect either interest rates or a trade or whatever it may be that may impact on our market. What do you see are the key things that may happen now around the world that might affect the market going forward? Like what trends are people like yourself who are in the markets, your head's in the market every day, what things are you thinking about and seeing kind of evolve globally that you think you're factoring into your decision making for the advice that you're giving to your clients?
So first of all, I use the top-down approach when I pick stocks. So I always look for big macroeconomic trends. Inflation is a big one. That's showing some encouraging signs, both here in Australia and the US. I'm confident that the RBA and the Federal Reserve will cut interest rates, right, which should support the markets. But there are other things to look at as well. We've got multiple wars happening around the world, right? We've obviously got one in Ukraine. We've got one in Palestine and in Israel. And, things are heating up in the Red Sea as well. And that's a big one right now. The Australian share market, it's so driven by commodities and commodity prices, right? So I'll just use the Red Sea as an example. So currently we've got, US warships and UK warships in the Red Sea attacking Houthi rebels. It's basically turned the whole area into a no-go zone, right? So you've got to think that all of these shipping and cargo companies that typically travel through the Red Sea, they now need to take a longer route, right, and go down the southern end of Africa and around Africa, which adds an extra 10 days to the journey. So not only does that burn more oil, right, and pushes up the demand for oil, but it can also add to inflation as well because it causes bottlenecks. So, there's plenty going on in the world at the moment. Wars are, as tragic as they are, it pushes up the price of commodities as well. And we saw a prime example of that, I guess, when Russia invaded Ukraine, right? We saw commodity prices skyrocket. Coal in particular went from $140 a tonne to $440 per tonne, as the West and America in particular place sanctions on Russian commodities, coal, gas, oil, and they're looking at adding uranium to that list as well. So it's all tied in.
I found that one pretty interesting, the coal price, given the push in the West to achieve green energy saturation. Just specifically on like green energy and coal, what's the interplay there and how do you think that will play out in the markets this year and going forward?
Yeah, it's a great question. So we read all these headlines about COP28 and all these global leaders saying that we're moving green, and I think there is that push. But I think that a lot of these leaders like to make these big claims to keep everybody happy. But the fact is, the world will burn more coal this year than it did last year, right? And these energy transitions take a very long time. 64% of electricity that was generated in China last year came from coal, right? They can't just flick a switch and turn it into nuclear power. They are building more nuclear reactors, but this all takes time. So, the demand for coal is actually increasing.
You mentioned before that you can service investors all the way through from the beginning of their life cycle to the end. And also, a word that you mentioned before was risk tolerance.
Yes.
Can you just explain for our viewers what is risk tolerance and how do you kind of gauge that when you have a new client come on board?
Yeah, okay. So shares is an asset class, right? So you've got a few main asset classes, starting with cash, right, in the bank, which is probably the safest because the government guarantees it. Then you've got things like term deposits, which is also government guarantees, very safe, but your reward on those two are quite low. Then you've got another asset class like government bonds, which the government guarantee, also very safe, but the potential reward is quite low. Then if you move up the risk sort of ladder, if you will, you can look at things like property. The Australian property market has returned on average about 7% per annum over the past 40 years. And then even riskier than property is stocks. The Australian share market's returned, I think, 9.1% over the past 40 years. And then a totally, at the extreme end of the scale, you've got things like cryptocurrency as well, which is, it's hard to sort of quantify that because Bitcoin's gone through the roof. So look, shares is quite risky, but then within the market, you've got your stable blue chip dividend stocks, and then you've got your riskier stocks that, are just sort of starting their journey. So how do I make members aware? I guess in all of the advertising that I do, the top of the funnel, it might be like top 5 growth stocks for 2024. And that would only attract people that are interested in growth stocks. And I think you've got to make it really clear, hey, what you're doing involves risk, and not every investment performs as expected.
So is it fair to say, Mitch, that the younger someone is, the more risk
they can take on?
Is that, and then conversely, the older that they get, you'd tend to move towards less risky investments.
Yeah, that's right.
So do you have kind of a general age? Is that the same for everyone? Is there age limits, or what would you recommend to the viewers for maybe based on their age, how much they should have in more riskier things versus?
Yeah, the young you are, the more risk that you can take on, because you're still working and you've got time up your sleeve. If we do see a market crash, it might take a few years, 3, 4, 5 years for the market to recover. Where if you're, retired and 70 years old and the market tanks, you don't have that time up your sleeve, right? So when it comes to stock selection, you've got 2 avenues. You can either buy an ETF, an exchange traded fund, which basically you're buying one stock that buys a little part of the top 200 companies in Australia, and that's probably your lowest risk, right? Because you're not overly exposed to any one company. You're effectively just buying the market. And that's great for people who are passive type investors that just want to be able to contribute some money every paycheck and grow their portfolio. And it's very hard to outperform that. Alternatively, if you're an active investor, that's an area where I may be able to help people in stock selection. And our goal is to outperform the market. So, and I always look for themes in the market. Right now, there's a big theme in energy, right? Crude oil, I think, is going to have a big year based on what we said earlier. There's a big push towards uranium. Uranium's red hot at the moment. So, that's how I do it.
So, Mitch, can you list some of your hot stocks, some of your favourite ones?
Yes.
Without giving any specific personal advice to the viewers, this is general advice only for discussion here. But can you list some of your kind of hot, maybe more riskier stocks, and then maybe some of the more ones down the other end that just kind of plod along? And
yeah, sure. So what I can do is give you a super risky stock, a medium risk stock, and a low risk dividend stock. Does that work? Do you want to start? What do you want to start with, the low risk or the super risk?
Let's dive right in. Let's go for the big one, the super risk.
Okay, so there is this biotech company that I really like at the moment, right? It's called Imugene, and the code is IMU. Imugene develop cancer treatments, all right? And I'm of the opinion the bigger the problem the company can solve, the higher the reward. There's not too many problems bigger than cancer treatment, right?
Sure.
Now, when it comes to cancer treatment, and I'm no doctor, but this is from what I understand, there's typically, if you get cancer, there's typically 2 lines of treatment. You've got your chemotherapy and radiation therapy, and that doesn't always work, right? Sometimes it fails. So what Imugene are doing, they're developing it's an oncolytic virus, right? Basically a man-made virus that is designed to select and kill cancer cells. if that makes sense. So if you get cancer, you go through chemo. If that fails, well, then you might be eligible to try some of Immugene's products. And they're developing this brand new therapy called CF33 Vaccinia, which is in phase 1. So if you want to be able to sell a drug or a therapy in the world's biggest market, the United States, you need what's called FDA approval. All right, and there's typically 3 phases: phase 1, phase 2, and phase 3. Phase 1 is treatment of a small group of people, typically around 30, and the goal of that is to determine whether that treatment is safe and works. Now, they've just completed phase 1, and 86% of the, I think it was 38 people they tried, showed a stable disease. So basically their cancer has pretty much stopped. One complete response in what's called bile duct cancer, which is a notoriously hard cancer to treat. So look, they've got a pipeline of multiple drugs, but this CF33 Vaccinia is one that stands out so much in fact that the FDA have just granted them what's called fast track designation, and they very rarely do that. Only if it's only for companies developing something that can't be solved anywhere else. And so watch this space on Imugene. It's high risk. The chances of FDA approval. I mean, in the world of biotech, 9 out of 10 companies seem to fail. The ones that get through make billions and billions and billions.
So is that an Australian company?
It's an Australian company. Yes.
That's a great story too.
Yeah, it's fantastic. And this is new news as well. These results only came out a couple of months ago. So if I was an investor and I had a high risk profile, I might want to consider putting some money into Imugene. And the way that I would start is I would, first of all, obviously open a share trading account through ComSec, or I use a company called Stake, Stake. I've had a good experience with. And then you just type the name of the company into that platform, or the code, which is IMU. And then you basically just go through and look at the company's ASX announcements and just read what I've just discussed and some of their presentations. But really exciting stuff. But once again, it's high risk, because any company that's still, well, Imugene isn't cash flow positive, right? It's got about $100 million in the bank, and because they don't have any FDA approvals, they're not selling anything. They've got a burn rate. I think the burn rate is about $20 million a quarter, right? So they're burning money quite quickly, and they will need to raise money to before they eventually produce. But it's a journey, and this is a company that I like the story and comfortable sort of being with them from the start.
Sure.
So that's the risky stock. Okay, it's really risky, but it could be really rewarding.
Right.
Okay, so that's one end of the scale. In the middle, a growth stock that I like at the moment. I mean, it's really hard to look past uranium. Uranium is red hot right now.
Right.
So if you don't know what uranium is,
can you just explain a little bit about what uranium is? And I've also heard a lot about what might interest some of our viewers. What is lithium as well?
Lithium,
yeah. So, and what's the difference between the two? What do they do? And can our viewers possibly, if they wanted to seek advice and go and do that, could they invest in either of those commodities on the Australian Stock Exchange?
Yeah, absolutely. I mean, the good news about Australia is they call us there's a book written in 1964 by a gentleman called Donald Horne called The Lucky Country, right? And it's talking about Australia and how we're lucky because of our vast natural resources. And he actually wrote that book ironically, but it's true. We've got so many amazing commodities in Australia that we can offer.
Our land abounds in nature's gifts.
It's true. It's true. We've got everything. We've got lithium, iron ore, coal, gold. We've got everything, which is amazing. So lithium and uranium, let me just sort of give you the 30 seconds on lithium, then we'll talk about uranium, and then we'll talk about this dividend stock. So lithium, it was so hot in 2021 and 2022, and it just sort of plummeted in 2023. So
why is that?
Well, first of all, what is lithium? It's the key element that's used in electric vehicle batteries to store the energy, right? So electric vehicles typically run off lithium-ion batteries. There was a crazy demand in 2021 and 2022, that sort of ended in 2023 at a time where supply was really tight. There was only a few lithium mines operating. So basically the price of lithium hydroxide, which is the refined stuff that it's like 99% pure, it's battery grade lithium that trades over in China. To give you an idea of how crazy things got, the price of lithium in China went from 100,000 Chinese yuan per tonne to 600,000 Chinese yuan per tonne in a matter of 18 months. The high was in 2022, and since then, it's fallen from 600,000 all the way back to 100,000. So we've seen this huge bull market and this huge bear market.
Right.
So why? Is that the question? What happened?
Yeah, I'm just listening. How did this go? So it went from 100 to 600 and then back down to 100. What's happened there?
So like the largest market for lithium or for electric vehicles is China. And we're talking about sort of pollution before, and China is getting serious about cleaning up their pollution. So they introduced this tax break that lasted for 13 years, and it ended at the start of 2023, January 2023, whereby if you bought an electric vehicle in China, the government would give you a rebate, and that was a significant rebate. I think it was worth about $4,000 or $5,000 equivalent in China's yuan, of course. So basically what happened, that tax break ended at the start of last year, 2023. So there was this huge rush in demand for people to buy their electric vehicles before those tax breaks ended. Right. So a spike in demand at a time where there was very few lithium mines in operation. I think there was about 6 or 7 lithium mines worldwide actually in production. So the price basically went through the roof. Now what happened, start of 2023, there was a lot of electric vehicles and batteries had been produced. Those tax breaks ended. The Chinese economy, it never really recovered post-COVID, so people stopped buying electric cars, and there was just plenty of stock on the market, batteries and electric vehicles. So last year, 2023, and more so, it included at the start of this year, 2024, the price of lithium has plummeted 82%, wow. Right? Because there's been more lithium mines have come online at a time where there's plenty of stock available.
And some of those mines are in Australia.
Most of them are, yeah.
Right.
Yeah. Well, we produce lithium spodumene in Australia, which is the stuff that comes out of rocks, and over in America, in South America, it comes out of the water called brine, right? Look, it's gotten to such...
Is the Australian spodumene more high quality than the brine?
Well, lithium's an element. So the stuff that we get here in Australia is of the highest quality, yes.
Right.
Yep. You can get some really high quality stuff out of the brine as well. They're just two different methods of extraction, right. Essentially, is what I'm trying to say. But is lithium dead is the question? No, it's not. So, I mean, if you look at the growth rate of electric vehicles last year in America, it surpassed 1 million units, which is a 50% year-on-year increase. It's still growing in China, just not as quickly as it was. Plenty of demand for electric vehicles and lithium. So I don't think lithium's dead. And in fact, I foresee a new bull market happening rather soon. The price of lithium has gotten so low where the producers that are at the higher end of the cost curve are not profitable, and they start shutting production. They start mothballing their mines. We've seen that recently with Core Lithium, right, who produced at about $900 per tonne for lithium spodumene, and that's currently where it's sort of being sold for at the moment. So they've said, right, for the wet season, because they're up in Darwin and it rains over this time of year, we're just going to mothball production. And what I think is other companies at the high end of the cost curve will do the same thing. So basically there'll be less lithium on the market. All of the stuff that's produced in China, they're higher cost producers, they will shut down production. So the market will naturally correct itself.
So let's move on to the other element now, the uranium.
Yes.
Can you explain a bit about uranium and
yes.
how the viewers, if they choose to, or might want to look it up online, do a bit of research about Australian ASX listed companies that they can invest in that deal with uranium?
So uranium, it's so hot right now. Uranium in 2024 is kind of like lithium in 2022. It's the talk of the town. It's made headlines. So what is uranium? Well, it's the stuff that fuels nuclear reactors, right? U308. And I think there's been a big push towards uranium ever since that huge spike in coal prices that we were talking about earlier, where the world's realised that they really need to sort of diversify their energy sources. Uranium, there are believers out there that it could hold the key to climate change, right? It's clean, it's reliable, it's secure. No one's going to steal uranium, right? And it's relatively cost effective. So there's 400 nuclear reactors in operation around the world right now. A further 60 are being constructed. Out of those 60, 32 of them are over in China, right? So they're getting deadly serious about turning to nuclear power generation, which is fantastic. Now, very limited supply. So the price of any commodity is driven by supply and demand, right? So supply is ticking up because more and more nuclear reactors are coming online at a time where demand is being hampered, right? So it can take up to 10 years to get a uranium mine in production, right? So demand's picking up, supply is quite tight at the moment, and that could be further exacerbated shortly if the US start placing sanctions on Russian uranium. For some reason, everything else Russian has been sanctioned, coal, gold, their payment system, but uranium has not been. But the Biden administration is looking at placing sanctions on that shortly, so that would mean less Russian uranium, and they're the world's top producer, less uranium on the market, and a further spike in prices. And another interesting thing that I've seen happen recently, I think the higher the price goes, the more headlines that we see. So then investors, especially retail investors, we get excited. And what people are doing is they're investing in exchange-traded funds, physical uranium ETFs, right? And there's this company called Sprott, they're SPROTT. They're probably the biggest physical uranium ETF in the world. The more that people buy this ETF, the fund manager physically needs to go out, buy uranium and store it as well. So there's a lot of speculation happening at the moment. And the price at the time of this podcast is about $100 per pound of uranium. So, it's the prices are just going through the roof at the moment. I don't think it's going to be sustainable long term, but I see it moving much higher this year.
So, Mitch, that was really interesting about uranium.
Yep.
Can you give us maybe your top uranium pick at the moment, or for an ASX listed share that the viewers might be interested in?
Certainly. So my top, we've got a few amazing companies to choose from. Boss Energy in South Australia is a fantastic company with a great Boss, BOE. That's great. Okay. They've recently entered production as well and should be cash flow positive this quarter. However, Boss is not my top pick. My top pick is Paladin Energy, right, which trades under the code PDN. So who are Paladin? What do? Well, they have bought 75% of the Langer Heinrich mine in Namibia. Now, this is a restart mine, and I know what you're thinking, Namibia, Africa, is that a good place to buy uranium? Stable jurisdiction, labour's relatively cheap, and there's an abundance of uranium. So Paladin, a few years ago, when the price of uranium had really bottomed out, came in and they purchased 75% of this Langer Heinrich mine. Now, the reason why I like it is because it's just a restart mine. It has previously been in production for about 10 years, sort of 2007 to 2017. During that time, the Langer Heinrich mine produced 43 million pounds of uranium at an average cost of $25 per pound. So we know that there's plenty of uranium there, relatively low-risk project because they're just restarting it again. This company, Paladin, is scheduled to go into production this quarter, Q1 2024. So they're in a prime position to capitalise on the current high prices. I would fully anticipate that they will be able to produce at about $20 to $25 per pound and sell it on the market, which is currently fetching about $100 per pound. So Paladin PDN is my top pick. No debt, fully funded, market cap of about $3 billion. So, it's still got room to grow as well. Plus, they've just picked up 100% of another uranium mine in Canada. So when this one runs out, they can look to get Canada up and running and open.
Can we now move on to the boring stock?
Yeah.
And why is it boring? And when would you typically recommend this to a client?
Okay, so the boring stock, it's not actually boring. It's, in my opinion, it's quite exciting, but it's I guess
mature.
Mature is the word, right? So it is in the coal space, right? I think the price of coal has bottomed out at $130 per tonne. My top pick is Whitehaven Coal, And it's not everybody's cup of tea, right? There's a lot of ethical investors out there that won't touch it, especially of the super funds. And I respect that. But Whitehaven is just a cash generating machine. They had their quarterly results this morning, and they were very, very strong. So, at the moment, the price of, and there's two types of coal, I guess is probably the best place to start. You've got your thermal coal, which is used to fuel power plants. Then you've got your coking coal or metallurgical coal that's used in steel making. Okay, so Whitehaven coal at the moment, I mean, they had their quarterly report this morning. They were able to sell coal for about 215 Australian dollars per tonne, and the cost of production was about $115 per tonne. So really healthy margins. They were able to produce last quarter 3.7 million tonnes. And they've got $1.5 billion cash in the bank. And what does that equate to? Big fat dividends for shareholders. So rock solid balance sheet, making plenty of cash and paying a lot of that out to shareholders. So that would probably be my top pick if I was retired looking for a source of income, something. And for some reason, it's trading on a price to earnings ratio, a P multiple of 2, which is ridiculously cheap, right?
Wow.
So I think that it is so cheap.
What is the ticker, the symbol for Whitehaven on the ASX?
WHC.
WHC.
And I think the reason why it's so cheap is because the big super funds won't have it in their portfolio because it's coal.
Right.
If you're a retail investor and it doesn't bug you that they're coal producers like myself, it's easy money, I think.
Mitch, so there are a lot of scams going around in financial markets. And seldom a week goes past where we don't learn of a new one. One that comes to mind is the Melissa Caddick scam.
Yes.
But there are other ones that have been going around for years. You go all the way back to Enron. You go to Bernie Madoff. There's been a lot of scammers operating in a kind of stock market settings.
Yeah.
How do our viewers, when they're going to invest in the share market, how do you avoid getting
ripped off
or getting scammed? How can you kind of sidestep those potholes?
General rule of thumb is if it sounds too good to be true, right? It is like it's not true. Anything that you see on Facebook that promises like an IPO, an initial public offering. I've seen one going around now. The SpaceX pre-IPO. It's a scam. I can tell you now that Elon Musk doesn't need Barb from Wollongong's $10,000. So look, that's your first red flag. Anything that says initial public offering, especially with an American company, because it's illegal anyway to advertise an IPO. What if people are promising high returns? Automatic scam, because you can't. Also, you've got to provide a financial service in Australia. You need to be registered with ASIC. You need an AFSL. So I would ask for their AFSL number. I would head to the ASIC website and I would verify that they've actually licensed to provide advice. And a really easy way of checking is just to go to Google and just type in the name of the company and check their reviews. Because if people have been scammed, they're going to write a negative review. So that's what I would do. I'd stay clear of anything IPO related. I would stay clear of anything that promises you high returns like AI trading. That's all a scam. I would check the Google reviews and I would ask for their AFSL number and I would go to the ASIC website and I would just do an advisor search and make sure that they're registered, because there are plenty of scams going around. I hear them. A week won't go by where I haven't heard of somebody getting ripped off. And it sucks. It makes my job difficult, very difficult, because people that don't know me automatically assume that I'm a scammer. And it's just the way it is. It's the world that we live in at the moment. But there are genuine advisors out there. But you just need, as an investor, you need to do your research. And it'll only take a minute.
Mitch, this has been such an informative session. I really want to thank you for your time. It's been fantastic. I've learned so much.
Thank you.
And for the viewers out there who want to continue the conversation with yourself, how can they reach out to you, get in touch with you so that they can maybe talk to you?
Yeah, not a problem. Look, I'd be more than happy to allocate some time to anybody that has any further questions. All they need to do is go to my website, InvestWithMitch.com, or Google Invest with Mitch. It'll come up. And on the homepage, there's a button that says book a call. It's that simple.
Mitch Stone, thank you for your time today.
Thank you. Cheers. Appreciate it.